Hello and welcome to the March MENA market briefing. It has been a tumultuous few weeks for global commodities since Ukraine conflict began on February the 24th. Today, I'm glad to say I'm joined by our lead oil analyst, Ehsan Ul-Haq, and we're going to discuss the market implications of international sanctions against Russia. So first, we'll look at the global benchmark prices in the context of global fundamentals and geopolitical risk. Then we'll size up Russia's role in the global marketplace and evaluate the buy-side response to geopolitical developments. So stay with us. So this is a long-term monthly chart for Brent crude, and prices have now traded to historic highs, as you can see here. Now, 4 weeks ago, we were talking about $100 Brent as a short-term price target. And back then, market consensus had Brent averaging at about the mid-70s to $80 level range for the first quarter of 2022. Now, if we fast forward a few weeks, we can see now that Brent has traded to intraday highs of nearly $140 per barrel. And on the March 7th, we had an intraday trading range which went beyond $14 per barrel. And on March 9th, there was actually a subsequent sell-off which saw a $26 per barrel drop in Brent. So, that level of trading volatility is almost actually unheard of in this market. And that volatility doesn't actually appear to be exclusive to financial markets and exchange-traded products, where speculators and algorithmic traders can often drive outside momentum moves. Actually, in fact, OTC swaps prices, and those are the forward contracts traded between commercial players. They've also exhibited a high level of volatility, and physical traders are also trying to grapple with the fast-changing fundamental factors affecting the market. And we'll discuss those more in just a little minute, but maybe Ehsan wants to share some context or some reflections on the price action you've seen over the last few weeks.
I mean, the first thing is that we saw very high prices in 2008, but it was demand-driven. And this year, we have seen, demand is recovering from the impact of COVID-19 pandemic, but on the other hand, it was mainly due to the impact of sanctions against Russia and the market's reaction to that. So as a result, it was a kind of supply-driven impact compared to demand-driven impact in 2008. I mean, some people have been forecasting prices of up to $200 per barrel, but probably we might not reach that level because there are some alternatives available, probably not the right kind of crude, but still we will be able to get some crude, and with the help of increasing supplies from others and allowing some countries which are under sanctions to restart their exports, we will be able to find more supply, although it might not be the same kind of supply.
Very good. There's hope for us poor folks suffering from high energy bills at the moment, at least. Let's take a closer look at those some of those issues, supply side issues and political issues right now. I mean, when it comes to when it comes to fundamental analysis and price forecasting, as you alluded to there, we know that most demand models they kind of broke in the wake of the COVID pandemic, didn't they? And forecasts, it seems to me, have consistently underestimated demand growth during the global recovery. I think it's fair to say, though, with commodity prices at current levels, the inflationary headwinds that we have been talking about in the recent past, these price levels, they start to become almost hurricane force, right? And I think they could well derail the economic growth and recovery we've seen post-pandemic. But the degree of uncertainty we saw on the demand side, it now seems to be transferring over to the supply side. And this map really demonstrates why. The geopolitical risk factors, they are widespread, and they're evolving so fast at the moment that it's actually very difficult to gauge the impact on the global oil trade. As a result, Russian entities and individuals are now facing a myriad of sanctions and embargoes, which have varied and complex ramifications for the global economy and for the physical energy trade. In addition to that, the US is still in talks with Iran regarding international sanctions and the nuclear agreement. And it's also now re-examining sanctions against Venezuela in the light of the global energy crisis that we are now enduring, and has gone from what might be described as severe to what is now described as acute. I mean, anticipating political outcomes in this climate is particularly tricky. And in addition to that, we've also got tensions in Libya. They're a constant threat to crude exports there. West African producers, they're struggling to raise output, as we've discussed on previous episodes here. And of course, OPEC Plus still sticking to their guns with their supply restraints and not deviating from their policy as far as we can see at this point. I mean, Ehsan, there's so much to talk about here. What's on your mind? What do you think? Take your pick, really. What's driving price? What do we need to be looking at?
I think, in addition to the impact of sanctions against Russia, which I think will not result in all crude oil exports and refined product export coming to a halt, but at least some of these flows will not happen, which will result in refiners looking for alternative supplies, traders looking for alternative products from other countries. So, but the problem is that if we look at South America, for example, it's not only Venezuela, other countries such as Ecuador, they are also having problems in boosting their production. Brazil is probably in a better shape, but even they have some financial problems. But Mexico wants to concentrate on its domestic refining capacity, and they want to reduce their supplies to 435,000 barrels per day this year. They exported more than 600,000 barrels per day even to the US last year. So it's going to be a big drop in supplies which are very similar to Russia. Then we have a lot of problems in Libya, and political situation is not stable. In West Africa, Angola is struggling to boost production. And then number of outages in Nigeria. If you look at the Middle East, Iran can easily increase its production and exports by a few 100,000 barrels per day in a few weeks. But the problem is that they are still under sanctions, and then it will take time before these barrels reach Europe. And before these sanctions against Russia, we were talking about especially the Mediterranean market, which has been undersupplied in medium sour crude, that market becoming oversupplied if Iran comes back. But now nobody thinks about it, and it will be more than welcome in the Mediterranean, also in Northwest Europe. In the North Sea, Norwegian production has risen because of the introduction of Johan Sverdrup, but UK production is stagnating at present, and it will continue its downward slide in the next few years. So, it's not easy for refined, especially in Europe. There's no alternative in sight for Russian supplies at present.
Yeah, I think definitely it's going to be really dependent, at least in the short term, on a decision on the Iran sanctions and maybe a path back for those barrels. We discussed that on the call on this podcast last month. So you can always go back and check that out for more takes on that. I mean, if we turn our attention back in a more detailed focus here on Russia, we've got a snapshot of energy sanctions that are currently facing Russian entities and individuals at the moment. Now, there is in fact a full list of sanctions available via Reuters, and that's on a dedicated Ukraine conflict page, which you can find on ICON. I think it's more to keep in mind that energy sanctions were to be avoided due to Russia's irreplaceable role in the global energy supply. However, they do appear to be steadily creeping in, as we can see here. The US has banned Russian oil imports, and the UK has announced plans to phase out imports by the end of 2022. Europe, obviously highly dependent on the Russian energy. They've not made any commitments on this, and it's unlikely that they'll be able to do anything or find any real replacements in the short term. Moving to the corporate sanctions, I think this is particularly interesting, actually. We can see that Shell, they've taken a decision to stop trading Russian oil. And that's really quite important in my mind because they're such a major player in the global oil trade. I think as high as 10% of traded volumes at some point. And then you've got other corporations also distancing themselves, but more through divestments rather than necessarily through cargo trading. And these developments, they will certainly have an impact on trading patterns. But my take is that if Shell doesn't take the Russian barrels, for example, that somebody else will step in and do so. Ehsan, what are your take on sanctions at the moment?
I mean, the first thing is that Shell, largest refinery in Northwest Europe, the Pernis refinery is undergoing maintenance at present. As a result, they don't need as much oil as in the past. Second thing is that there are some companies such as Hungary's MOL, which are very much dependent on Russian oil. They get their oil, they are landlocked and they only get Russian Urals via the Druzhba pipeline. They also have a refinery in Slovakia. So these countries, they for them, it's very, very difficult to replace Russian barrels. As a result, compared to Poland, which is in favor of introducing some Europe-based sanctions against Russia, Hungary's MOL, as well as its Prime Minister Viktor Orban, is not in favor of introducing some sanctions against Russia. So it's different from country to country. And if you look at the UK, if you look at the US, they are not too much dependent on Russian oil as the rest of Europe. As a result, they can easily afford replacing Russian barrels with other crude from other producers. So it depends on dependency, and this is different from country to country.
Definitely. And important to note as well that if you look at the flags, they're all Western flags and all Western companies in this case. So Asia very much sitting on the fence by the seams of things at the moment. Okay, let's take a little look here now at Russia. I mean, obviously, it's a major player in the global oil market, and I think production roughly around 11 million barrels per day. If I'm not wrong there, Ehsan, correct me otherwise. It's about 12% perhaps of global production.
Correct. Yes, you are right.
So here we have a summary of their export data taken from Russian customs, and courtesy of the Refinitiv research team in Russia. The top chart there shows approximations of Russian petroleum exports through 2021 on a KBD basis, 1,000 barrels per day. We see that crude exports totaled 4.4 million barrels per day, fuel oil 930 KBD, middle distillates 870 KBD, light distillates 530 KBD. So by no means are these small amounts. And the tables there in each case summarize the top 10 sovereign destinations for those exports. I think importantly, US features quite high on the buyer rankings in some cases, which means Russian suppliers must obviously find an alternative market subsequent to the ban. And European countries, obviously major off-takers, particularly in the space of middle distillates, where Europe is generally a major importer and short in terms of refining capacity relative to regional demand. And then looking over to Asia, China, South Korea, also regular customers for Russian crude and products. And it's important also to note that how these barrels move. Obviously, a large proportion of that is seaborne, but a good deal as well is via pipeline, as Ehsan's already mentioned to us already. I don't know, Ehsan, are you observing any? You obviously monitor these cargoes and these movements on a regular basis. Are we seeing any impact short term subsequent to February 24th in terms of exported volumes?
I think as far as crude oil is concerned, we are seeing efforts by some refiners to diversify. They are not getting rid of Russian supplies altogether. They are just diversifying. For example, Poland's PKN Orlen, they were able to come to an agreement with Aramco. Aramco will take a share of PKN Orlen, and as a result, they will increase their supplies. Probably all of these supplies will come from the Egyptian port of Sidi Karir. These will increase to more than 300,000 barrels per day. I mean, then the refiners in Finland, Lithuania, Sweden, etc., they are diversifying. They are buying, for example, more Johan Sverdrup, which is in quality very similar to Urals. It's heavier, but if you add a bit of North Sea crude, then you can easily bring the average to approximate the same level as Urals. As far as refined products are concerned, I mean, if Russia is unable to export its refined products, Russian refineries, they will be forced to cut runs. And we have already seen some impact. Their storages are full. A refinery in the Black Sea was forced to halt its operations because its storage is full and they are unable to export. I mean, probably the same will happen in most other refineries. Russia and Ukraine used to have a total demand of around 4 million barrels per day. It's down by at least 1 million barrels per day. So their own demand is down, then they cannot export. As a result, it's bad for their refineries and they have to cut runs. There's no other possibility. And then they are ending up with too much crude, which they cannot process. So it's not easy for Russia, also not easy for Europe, but Europe will probably not cut its runs as much as Russian refiners have to do.
Yeah, okay. Potentially room for more crude oil exports in that case. If there's a possibility, if they can find a buyer and if they can solve any logistics issues that they might have on that front as well. This gives us another picture here, or a look at similar data, but this focuses more on crude oil. And again, this is from the Russian customs data. It just shows off-taker by grade. And we can see just a little bit more clearly the amount of crude oil imported by the various customers. I mean, China is absolutely enormous in terms of its offtake. You have to wonder if it could even take any more Russian crude oil if it wanted to. But, focus there on the US and the UK. US importing 140,000 barrels per day of crude, UK at 56,000 barrels per day. If you lose those markets, it doesn't seem like it's absolutely disastrous, at least in terms of placing barrels with alternative buyers. Any further comments on this one, Ehsan?
There's also some regional difference. If you look at China, if you look at South Korea, if you look at Japan, they import a lot of ESPO compared to European refiners, which predominantly import Urals. So ESPO is lighter it is distillate-rich crude. I mean, Urals is also a distillate-rich crude, but it yields much more fuel oil than, for example, ESPO. And then you have other countries. I mean, if you look at countries like Romania and Bulgaria, they are in the Black Sea. For them, it's very difficult to replace Russian barrels, and I think they will continue to get some Russian crude. Although what we have seen recently that they have been trying to get at least some crude from other producers, and probably they might accelerate their attempts to find alternative barrels, which is not easy for them. So it's not only countries which are landlocked, but also countries which are very near to Russia. Although I think they will have to face higher freight, higher insurance costs, because if they are importing from the Russian port of Novorossiysk, it's not going to be so easy. And then we have to look at CPC blend. CPC blend is a Kazakh crude, but it's exported via the Russian port of Novorossiysk. In addition, it contains up to 10-12% of Russian oil in it, because it's a blend. So as a result, for them, it's becoming difficult, and their crude has also come under downward price pressure, and probably this might continue in the future.
But also a factor for legislators as they're defining any further sanctions action, at least considering the consequences for Kazakhstan on that one. I mean, we talked about alternatives. You mentioned alternatives there, Ehsan. I mean, this is essentially the shopping list, right? This groups our crude grades by API and sulfur, and we've got the Russian grades in the very dark blue, blue dots there. I mean, what are your alternatives and where do they come from? We've mentioned already Iran, Ehsan. In the case of Urals, you've got their Iranian light, Iranian heavy. I think maybe a lot of buyers, as you mentioned, will be hoping there's a path for them back to market in the short term. ESPO there as well. Looks like we've got some, maybe some African, North African, West African grades there to consider. Any thoughts here in terms of if you're a buyer of Urals in Europe or a buyer of ESPO in Asia, you know, what's your go-to supplier if you can't buy Russian barrels?
I mean, the Mediterranean used to be a large buyer of Iranian crude, and if sanctions against Iran are lifted, then probably the Mediterranean will once again start importing some Iranian crude. And Iranian crude used to come directly from Iran as well as via the port of Sidi Karir. And hopefully then they will also be allowed to export crude from the Egyptian port of Sidi Karir. I mean, that's what it looks like in the Mediterranean. In Northwest Europe, as I mentioned before, you have Norwegian Johan Sverdrup, which is an alternative. And then you can import some crude from the US, especially, I mean, if Strategic Petroleum Reserve release results in more medium sour crude being released, then it's good news. It's good news for Europe, because Mars is very similar to Urals. Other grades from the US, Poseidon and Southern Green Canyon, are also very similar. As far as ESPO is concerned, you have to look at alternatives from the Middle East or Europe, which means probably Murban, Qatarland. I mean, these are good grades. As far as West African crudes are concerned, their exports to Europe are very much dependent on the Brent Dubai EFS, and the Brent Dubai EFS has been very wide. But we have still seen some Indian refiners, for example, going for these grades, because these grades are rich in distillates, and demand for diesel is relatively high in India, although there will be some impact of high diesel prices on end consumers in India, and elections are over, and so probably the government might increase fuel prices in India. As far as Angolan grades are concerned, they are also very similar to not only to ESPO, but also similar to Urals. The only problem with Angolan grades is that they are high, they have high acid content. And some refiners, especially with simple units, will not be able to process these crudes. So these are a few alternatives. And then refiners, complex refiners, they are always able to blend different crudes to find something which is similar to their average crude slate. So for them, it's easy. For simpler refiners, it's a difficult task to replace Russian barrels.
Absolutely. And then also there's competition from other players which are driving prices on those barrels. And we can see here, these are some spot prices for dated Brent linked spot cargoes available on Icon. And the orange line here, that's Urals prices for Northwest Europe. And the purple line there, that's 40s. I think it's fair to say they're not very different in terms of their qualities and their yield structure as well. But the price there, you can see, is highly divergent at the moment. Urals pricing now, or as we last saw it, $28.50 below dated Brent. Looks like 40 is getting a little bit of uplift there. Perhaps benefiting directly from that. Are you seeing any other spot prices on particular grades in Europe benefiting, or perhaps from what's happened over the last couple of weeks?
Yes, Tim, one thing worth mentioning is that 40s used to be a sweet grade, but the introduction of buzzard buzzard is being added to the 40s stream, which has resulted in 40s becoming a sour grade. And as a result, it's directly competing against Urals at present, and refiners which are desperate to replace Russian barrels are very often opting for 40s. 40s also used to go to South Korea because of a free trade agreement with South Korea. Also, Chinese love 40s and Johann Sverdrup, but the problem is once again a very wide Brent Dubai EFS. Other alternatives, as I pointed out, Johann Sverdrup from Norway, which is heavier than Urals, but has very high distillate yield, so which is a good alternative. Then you have smaller fields in the North Sea, such as Captain, which and all these grades are heavy, and they can be blended with lighter grades from the North Sea or from North Africa or from the Caspian to bring them very near to Urals quality. Yeah. So these are a few alternatives in Europe.
To say though, with that price difference there and Urals that cheap, while other grades are getting bid up, you've got to ask yourselves as a refiner. It's a tempting proposition at that price, and potentially with very strong margins, but the margins might not be as clear cut as this price chart suggests they might be. And Ehsan, you pulled something together for us here, which is quite interesting, and it really breaks down the Urals trade on a spot basis, I believe, to from Northwest Europe to Asia. But perhaps you can just talk us through your analysis here.
I mean, as we have seen in the previous chart and this chart as well, Urals in Northwest Europe is trading at a discount of $28.50 to dated Brent if they are able to sell it. But if we look at costs of sending Urals, which some Chinese trading companies and Chinese companies would like to have, then you have to consider, first of all, you cannot send Urals directly from Russian ports of Ust-Luga and Primorsk because of some rules and regulations in the Baltic Sea. So you have to bring them on Aframax at Suezmax to somewhere near Denmark or the UK, where they can be loaded on larger vessels, VLCCs. So the cost of shipping oil from Primos to Rotterdam are around $4.75 per barrel. Then you have to consider additional freight of around $3.25 per barrel from Rotterdam to Singapore. Then you have ship-to-ship transfer costs of around 50 cents. And then you have to also consider that Brent is at a premium of $12.65. As a result, Brent-related crudes are expensive. You have to consider then this Brent Dubai EFS of exchange of futures against swap of $12.65 per barrel. And the last thing to consider is dated to second month Brent backwardation of $9. It was almost $10 yesterday. So you have to, because if you send a cargo from Europe to Asia on its way, it loses value because of a backwardated market. So in total, you end up with costs of something around $30 per barrel, which is very much in line with Urals Northwest Europe's discount to dated Brent, which means probably the market sees Urals probably being priced in Asia, not in Europe, so which has resulted in such a huge discount. I think that if European refiners continue to buy some Urals, this discount, Urals discount to dated Brent might narrow a bit, but I don't see it returning to levels of less than $5 as we saw in the past. So I think Urals will remain at huge discount to dated Brent.
Yeah, well, it's interesting. It's still actually perhaps not entirely profitable to trade it to Asia based on the economics you put forward there. But if you're a Mediterranean or Northwest European refiner, your costs are going to be considerably lower, and therefore there's some very attractive margins potentially there if you can continue to buy it. I think that's amazing detail and some amazing insights, and thanks, Ehsan, so much for joining us on this occasion. Just to close up now, I'd say the legal impediment to buying Russian oil, in my mind, is still restrained at this point. Yeah, you've got a US ban of 140 kbd on crude imports. Russian imports. UK looking to phase out, so we've got about 200,000 barrels per day backed out in terms of Russian oil exports on the market. Now, if they act alone, that's not really a grave concern for the marketplace, and perhaps doesn't really justify prices, at least for Brent benchmark, as high as we've seen them. But we do perceive that there's a falling risk appetite by quite a number of commercial players when it comes to trading Russian cargoes, and that could drive a wider voluntary boycott on Russian oil potentially. If that happens, we'd have to question whether or not alternative buyers and players would step in to take on that risk. And that's at this stage anybody's guess, and to the discretion of traders and company directors. Ehsan, just to close the call and finish up, thoughts on benchmark prices at these levels and their sustainability?
I mean, it will depend whether refiners are able to replace Russian barrels. What we also see now, we are in March, and in a month or two, there will be some seasonal maintenance, which will result in lower demand for crude, which might also help. And then, I mean, probably the release of only around 60 million barrels of strategic petroleum reserves might not be enough. I think the IEA has pointed out that they might ask for more release, which might happen, which could be helpful. And then probably the release should be of the right kind, which means crude similar to Urals. And then if sanctions against Iran are lifted, sanctions against Venezuela are lifted, and the Middle Eastern countries such as Saudi Arabia, they increase their supplies because Saudi Arabia and other producers in the Middle East, they are coming on intense pressure from the West. So I think if all these efforts could alleviate some supply concern, which might result in containing the surge in oil prices. I don't see prices going towards $200 per barrel, but I mean, as long as supplies are limited, probably oil prices will remain above $100 per barrel.
Fantastic. And with that, we'll close the call for this month and invite you all to join us again next time. Ehsan, thanks so much for joining us.
Thank you.